All right. We should be going live soon. Trying to get the video up. Okay, they're screwed. Like their entire website's down. Okay.
Here we go.
All right, let's see if we can, if they can get the website online. All right, cool. Hey guys, welcome everyone. Right, welcome back to TheAlgoOracle, as well we say. I think we're gonna take it easy today. I'm just gonna have a very chill chat about what's going on. It's been a couple of hard months for everyone. So we're just gonna take a look at the charts, take a look at the video together. The latest update from the Fed. Oh, there we go. They seem to be back, but their website is lagging like hell. And so we're trying to get a video feed in for you guys, but it's yeah, it's not working for anyone.
So what is the Fed? What is the Fed? The Federal Reserve.
Man, there's so many people connected to this website right now. It's just shit. Do you want to make any comments?
Created the Fed in 1913.
Oh, nothing. I'm just seeing the volatility.
Yeah, I know. I did.
On the left.
Yeah,
There's
so
a 1 minute chart. You can see like 2% swings.
yeah, if you take a look at the charts, we've been here for a few minutes, guys, and like in the minutes of being here, pulled off of 5%, went back all the way down on the 4, and the volatility is definitely there. This is just a 1 minute chart, you know. Don't
There's a lot of volume as well, which is good.
All right, there we go. They brought back the live.
All
right, I'm gonna be on mute for a second. I just want to double check for everyone that we have good good audio on the other hand.
To develop and implement effective U.S. monetary policy.
Today, the Fed performs a number of important functions, all with the ultimate goal of promoting a healthy U.S. economy.
One of the Fed's most recognizable functions is conducting U.S. monetary policy, which involves influencing interest rates and the availability of money
all good.
and credit.
All right, so we're just gonna wait for them to get started. They said 7:30. They usually tend to start a little bit earlier. So let's have a chat about what's going on and what's been going on in the last couple of weeks. I think the whole capitulation of the markets, if we take a step back, so we take a look at the price, let's go back and take a look at the 1 day. Right, so we posted a couple of tweets last night, which were fairly interesting on the price moves. So we had a fairly relevant price move from the previous support zone. I think it's about 30%, just about 30%. And the move that we had yesterday, the last couple of days, was exactly the same type of move. So if I had to venture a guess in a maybe more less volatile market, I would have expected to see something like this, right? So we expect something like that, and we are in this channel, so I would have expected a bounce up or somewhat of relief at least for a couple of days. I doubt that because we have a bet going on here between crypto oracles. I'm going to say that the Fed is going to hike the rate by at least 75 bips or 0.75%, if not 1%. That's something that we haven't seen since the 1980s. And the guy here is saying 0.5, which I highly doubt.
Yeah, I want to be contrarian. I think if you pull up the chart of the euro-dollar futures,
can you link it to me?
I think we discussed in our Discord today. You can look in on TradingView, I think.
Let me pull it up. Yeah, let me pull it up on Discord.
Yeah, this is a very good chart to understand the expectation of rate hikes, and yeah, basically, I mean, if you don't worry if you're gonna pull it up, but
yeah, I'm looking for it. I'm just. Do you have it in your favorite?
No, just look for euro-dollar.
Oh, okay.
On the future, yeah.
Was that a USD or USDT futures?
No, euro-dollar like that. Yeah.
Euro-dollar futures. We're looking for CME.
The first one should be alright, I guess.
First one is in Russia. You definitely don't want to get that now. All right. Canadian.
It doesn't matter. The euro-dollar future is a very good gauge of the...
Oh, there we go. That's it. Yeah, that's it. All right. All right, I will let you...
This one?
Yeah, it is. It is. It's the same one from today. It's the one we were talking about this morning.
No, it's not. It's not this one. Oh yeah.
Well, it should be the same.
I mean, it doesn't matter. You can find that Eurodollar future is a good gauge of the expectation of rates. Right now, it's sitting at 96.6, and that means like I think that 0.75 raise is fully priced in, and everyone priced in right now, and they actually expected the Fed to be able to raise rates until 3.5. I mean, the market is forward-looking, and I mean, right now it's dropping together with time. And other thing that I want to say is that in general, I think the work has already been done by the market. Like if you look at 2 years treasuries, 10 years treasury, they're already at 3.6, 3.5. So basically the tightening has been already done. The Feds are just doing this psychological games, and actually they're causing the move, but then the tightening itself has been already done. Like you can already see all the 10 years in 3.6 and 2 years in 3.4. I mean, the yield curve is all pretty much inverted, which is not a good sign.
All right, I'm just gonna pull this one out. That's the chart you're referring to, right?
I can't see anything. Oh yeah, this one. Yeah. There we go. Yeah, you can see 3.5. So when it's around 100, it means the expectation is around like 0. When it's drops lower, the difference between 100 and the current level is the expectation of the rates. And since the market is forward looking, is always looking at what the end of the tightening cycle will be. And right now is 3.5. I don't know if they're going to be able to. I mean, it looks like we're going to get into a high yield kind of environment, high rates. But then I don't know if the system can actually sustain it, because we have like
simplifying that. What does that actually mean for inflation, though? I'm just trying to simplify for people that are not really familiar with this.
Yeah, I guess, I mean, holding bond is still a stupid idea at the moment, because they're yielding you 3.6 and inflation is 8.6. So you're basically losing 5% holding them. So it's negative yielding. And
negative yielding,
I think that's why
you get less than what you put in. You actually lose money.
I think that's why the bond market is selling off so much. And I think the bad thing for the economy itself is that we are so over in debt, and in general, like the debt to GDP is like 130%. So the more yields goes up on bonds, the more interest payment the state has to do. So the more taxes, the more expensive. So they cannot really afford this type of environment too much. That's why in the past there's always been like this called the so-called Fed put, of where the Fed was just saving the market and reverting and pivoting and easing. But right now, because of inflation, they cannot do it, because they have to fight inflation. So we are kind of the middle. They have to choose between recession or inflation. And what they always refer to as soft landing, but I'm not sure they're going to be able to do it.
Just calling it. 1 minute, calling shit on 1 minute chart is basically impossible. So I'm just playing around, guys. This is definitely not trading advice in any way. All right. I mean, on a high level, I think that some people on the call maybe not that familiar with what we're talking about. I mean, the whole idea of inflation, it's basically the whole idea that your money is worth less, right? And if your money is worth less, you have less buying power, right? So you say you make 1,000 euros a month, and then your gasoline doubles in price. But it's not just gasoline, because gasoline may have to do with the war in Ukraine and Russia, and then we had geopolitical considerations to make. But if you think about price of fruit or oat or any commodities, that could literally be rent as well, housing market, all of that is inflation, right? So if your cookies go up by 50%, if the price of your cookies goes up by 50%, that's inflation. And it's not reflected, right? But inflation right now is 8.3, 8.5 was the 8.6, right? So 8.6, which means compared to last year, you actually, if you didn't have any investments, if you didn't have returns in your income on a year basis, the same as last year, you actually lost 8% of your whole money in 1 year. I know that in your bank account it looks like your total amount of money is going up, but because you're maybe saving and things like that, but you're actually losing 8% a year. So if you're saving 100,000 euros, you probably
the crazy part that the best asset you can see right now is actually the dollar.
Well, yeah,
because everything else is tanking.
Yeah. Well, yeah, it's probably gonna flip pretty soon, but
I think talking about interest rates, the thing that you can, I mean, the consideration, the consequence that you have to take is that the cost of capital increases by increasing interest rates. So basically, everyone that before was like, in order to borrow capital, had to pay, for example, 0.5. Now, with a raise of 0.5, we have to pay double of the interest. So the cost of the money is double. So if you before you could afford something, now you need to spend double monthly to actually afford the payment, and the system was so addicted to it. So the liquidity gets drained. So yeah, that's usually what the consequences on the market is, just way less liquidity and the market just tanking.
Yeah, I mean, I think like to kind of explain some people here on the call, like what is the Fed trying to do, right? So by raising interest rates, by hiking interest rates, basically trying to bring inflation down, but by somewhat contracting the economy. So on the short term, that's definitely going to bring stocks down. The markets are going to be down, cryptocurrency is going to be down. On the long run, the idea is to put a little bit less pressure on different parts of the economy, parts like the supply chain, the job market, and so on. So I think that's
I think the idea is just like basic economic 101. They're just trying to reduce demand by raising interest rates, because right now there's a lot of, the velocity of money is very high, and this is causing inflation together with all the commodity crisis, and especially supply chain crisis.
I'm gonna try to call a few things on the 1 minute chart just for fun. This is nearly impossible to trade on, to be honest, but let's see what happens. So it's pretty much just waiting on this as we wait. A couple of news from this week. I think the whole thing kind of started with Terra Luna ecosystem collapsing, and the whole idea is, there you go, I'm not that shit on a 1 minute chart. So the whole idea with Terra Luna collapsing, and all the conspiracies behind BlackRock being involved, CTV involved, I mean, none of that has ever been proven. I don't think none of that will ever be proven. Now there is another story that came out yesterday about Do Kwon, who's the founder of Terra Luna, actually withdrawing $2.5 billion from the ecosystem just before it collapsed. Still, under discussions, but I wouldn't be surprised, to be honest. If you're a multi-billionaire one day and you know what's going to happen, and that's your life savings and project, I wouldn't blame the guy, to be honest. Although at the same time, what's interesting to notice here is that these things that happen in the stock market in the past, in the 90s, in the early 2000s, every time something like this happens, or somebody crashed the currency, that was jail time. You went to jail for a long time. This is like it's considered a serious crime, right? Because it's considered as market manipulation. If you can crash something, you're manipulating the market somehow. And what's crazy is that because these markets are unregulated at the moment, then Do Kwon is pretty much free to walk away and don't have any consequences, which is fine in the idea of decentralized systems. But at the same time, if you think about how many people actually lost money, and I remember on Reddit there was, on the night that kind of everything started unfolding and UST started debugging, the main post was about suicide hotline, right? So there is people that kill themselves after this. That's definitely sad. And then now on the back on that, you can probably mention a few more. We got Celsius now kind of experiencing a similar issue and blocking all the withdrawals. Do you wanna fill people in on that? You probably know a little bit more.
Yeah, definitely. I think they're actually still, right now they're starting the prosecution of Do Kwon as well. So this kind of event definitely attracts attention of the authorities. So there's definitely going to be consequences for him. And I think the consequences of Terra Luna collapse is around I think 47 billion liquidity there was in the market. So you will see a lot of cases of insolvencies or people not actually having the money they're supposed to have. So one of the examples that we have is Celsius this week, that they closed withdrawal swaps. And they have 1.7 million users. And basically, it's always coming back to know your coins, know your keys, know your coins. yeah, in this case, yeah, they block all withdrawals. So yeah, many people were not able to withdraw. I think they're still blocked right now. We see if any other cases like these happen. And I think BlockFi is doing fine, which is good. And yeah, I think also in general, one thing to consider is all these products that were giving yield during the bull market. It was easy. There were a lot of arbitrage opportunity. There was a GDBC arbitrage trade, and all the contango trade. And right now, it's not as easy to get this kind of yield to offer to your customer. Then you have to go, that this institution have to go further how the risk curve, in this case was Terra Luna. And there's definitely there's consequence of taking the risk, even though if it's small, and it can happen, we know that it will happen. If it's possible, someone will try to exploit. And yeah, I think there's gonna be even more cases of people not having the money, and possibly, I think they did it in order to prevent a run in the bank, a classic. So it means they probably don't have all the funds they were supposed to. And I think for the space, like in the future, we should probably, it's so easy to verify this digital asset that you either have it or you don't. And it's a cryptographic proof. It's not as hard like in the normal world. So we should definitely, like the regulation should definitely come on that place. Like for custodian, there should just be a monthly or weekly proof, or just submitting the proof that you have the assets. And they will definitely.
Well, I mean, until you got regulated, unregulated market, that's not going to happen. Sorry, I just want to brag about my 1 minute charting. There you go. Support resistant and a 1 minute. That line was a little bit longer, but bring it close. That's pretty close. I mean, this is just speculating, but let's see what happens. One thing I want to show people, since we got people on the call here, got quite a few people watching. Let me show you something interesting, guys, that I wanted to bring up since we're talking today. So, and maybe we could talking about it. I know this is a very light preview, but I think this is worth showing. What do you think? Do you want to say a couple of words about what we're doing here?
So 1 second. Yeah, definitely. Yeah, we launched the first version of our website, and yeah, it looks pretty cool. We did it ourselves. They were mostly developer. And then we expanded to the design team. So we're actually working on the version 2 right now. We did all the new restyling to make it look cooler. But then at least all the functionality is there. You can contact us, and this is just a preview version only for the people that are interested to know more. And we will actually, it's already online, but then the link is not public yet. And we want to just use it to the people that are more interested.
Yeah, I think it's worth mentioning to people that are here today. I think what we're going to be doing and what the group is about. So TheAlgoOracle, the whole group, we are basically doing group investments together. We'll be doing it for about a year, doing educational content. Now we're developing this platform that is basically going to be your one-stop shop for cryptos. So anything you have to do in the crypto space, we're going to have it on the platform, from market data, from news to tweets, alerts, bots, NFTs, pretty much anything we're going to build there. Algos, automated trading strategies, automated trading systems, anything that you can think of. So we're going to build that in our portal. And the way this is going to work is for our NFTs. So you've seen our NFTs on Twitter. If you don't follow us on Twitter, you can just go on our website and click on the Twitter logo, the one floating up here. And that will give you access to the NFTs. So if I had to go and take a look at the NFTs page. All right, well, this kind of explains it a little bit better. So yeah, the idea is that we'll have the DAO, which is our group, and this will be how we will do group investments, and it will be as automated as we can do it. The TheAlgoOracle Labs, this will be blockchain development and consulting. So we've been developing university courses for a university in Malta. We've been working together, developing different course material. We've been working as consulting for different projects in the metaverse space in the last 6 months or so. And then our own portal is what you get access. So the idea is that we're going to sell some NFTs just to give you access to the portal. It's not about trying to do a cash grab for the NFTs. It's actually to give you access to a tool that we're all going to be using. But of course, because it takes us quite a lot of work and quite a lot of money to build these tools, we do have to get something back. But that's our idea. We're going to publish our light paper soon. I think actually this should be linked to our There you go. So this just kind of explains a little bit better what TheAlgoOracle is, and this is pretty much what we've been talking about now, where we are, what we do. So I will let you scroll through this if you go and check out the light paper on the website, and I definitely recommend doing that if you're interested in the NFTs. But if I go back to the website just quickly, that's our team. So that's all the people that have been working with us, and there is actually many more that just joined recently, fill in these positions. If you want to join us, just go on the website, click join, and you can fill in a questionnaire. Once you fill in the questionnaires, it will reach out to us and reach out to you. And what else we got? We got a roadmap here. So this is kind of explaining how the different phases are divided in. So we're going to start with NFT collection and development. So we got our own NFTs developed by an artist in Italy. We're developing our first investment DAO and the portal, which I just showed you here on the website. Then phase 2 is whitelisting. So we're going to whitelist people, start doing competitions and giveaways. Phase 3, we're going to launch probably towards the end of the year, and we're going to launch the portal, and then we're going to start adding tools. One thing that we've been doing as well, we've been working with charities. So if you know Surfrider, we're working with them to do a massive NFT drop. We've been working with Parlay TV in Chile. We've been working with other associations in Italy as well. So we're hoping to to bring some good out there as well. We're doing it completely for free, not for profit, just to sponsor some good projects. And I can even give you, since there is only 15-20 people here on the call, I can give you a sneak peek of the first version. So the idea is that you're going to get a dashboard, kind of looks like this, and it kind of pulls all the data in of what you want to see. We're going to divide it in future options, audio, YouTube, and things like that. So here you're going to have your channels that you follow, and so on. And then this is going to be both a website, and you will be able to download it on your phone. So just to give you a preview, this is how it looks like from your phone. So it looks pretty neat as well from there. All right, let's go back to the meeting. Let's see what's going on there. Still nothing. So that's all right, cool. So should we have a chat about what do we think is going to be happening then in the next couple of weeks?
Yeah, definitely. I mean, hopefully we're not going to break lower. It's going to just be at least a pause, as you said, jumping around. And I think there is, I think most of the capitulation and the forced selling already happened. So this might be the actual, let's say micro bottom for now, depending of what happens on this meeting. And
we got a
question. I think 0.5 was very bullish. 0.75, I think it's already priced in. So
it is priced in the markets. I don't know how priced in is in crypto, but it's definitely, if looking at Nasdaq, it was definitely being priced in. We got a question on YouTube from Wilden. He's asking what's going to be the impact on crypto of the Fed meeting. I think to answer you on a technical level, I think what's going to happen is we got two scenarios. So if you let me step out a little bit on the chart, the first scenario that I can see is we break down, they announce a 0.75 to 1% rate hike, and we break down. So we break this channel. We've been trading into this channel for a while now. We break below, which we're kind of already doing now, and we go into the first support zone that we have at about $18,000 to $19,000. Below that, it's all the way down to 11,000. We don't really have much support before that, to be honest. We have never really ranged in there for long. So if the meeting goes the way I think it will go, we will see a further dip. We'll see Bitcoin trading at about $19,000. That's my take. If the meeting goes like the other guy, the TheCoinOracle here is saying, I think we're going to see a bounce. Where is the bounce going to go? Well, kind of hard to say, to be honest, I don't think we're going to go all the way back up to 30,000 just because of this, because this dip wasn't caused by possible rate hikes. But if we take a look at the Fibonacci levels, we can actually get an idea where we think they should go. So let me just get that out. There we go. So, right. So I think, yeah, this is more realistic. I think if we see a bounce up, and let's take a look at percentage-wise, this could be a slight gain from the last couple of days. We do have support zones. I think, yeah, if it goes the way the TheCoinOracle here is saying, so the Fed announced a rate hike of 50 bips, 0.5%. I think we can probably look at Bitcoin in the 22,000, 23,000 range. So about 10% where we're at now, which is pretty healthy. I mean, if you're looking to do a trade, which is what I'm looking at to do right now, I literally have my finger ready to either buy as soon as Jay Powell says that the rate is 0.5, or place a limit at 18,500 as soon as he says it's 1%. So if you're looking to do a trade here, I think you could probably bring home a good 3-4% on the upside, and probably buy quite cheaply and hop in a relief bounce on the downside at about 18,000. And what do you think? You have the opposite view, so I will let you say what you think. So what do you think is going to happen on the crypto space, depending on what they announce?
Yeah, I mean, the past always told us that the Fed always comes to rescue the market in general. This is actually the first time that we'll probably not be able to do it because of inflation, because it needs to combat inflation at the same time. And the only way that they have is to raise rates. So in my point of view, that they won't be able to, let's say, save us, but they still be able, like, I think that the third mandate, which is not the official one of the Feds, is like market stability. Like, I think that the other two are like maximum unemployment and then price stability, but then the one that there's no official, I guess, is actually not let the market tank. That's why most of the times they always revert when the situation looks very bad. And I think in this kind of situation, they still have the opportunity to look like they're fighting inflation at 0.5, 0.7 is still looking like they're doing their work, but at the same time not crashing the market. So that's why I think the 0.5 is still in the cards.
Yeah, you're the only person left on the planet to say that.
Yeah, I know. That's why it's gonna happen.
I'm so much waiting for it to say 0.75 to your face. I mean, if you're right, okay, we made a bet. If he gets it right, I owe you 1 Cardano, which one day could be a lot. But...
Yeah, you never know. In 20 years, it could be thousands.
Oh yeah, of course. I'm gonna give you 1 Cardano, and then see. What do you give me? Is that 1 Cardano on the other way?
Yeah, let's do that.
1 Cardano each. Okay, cool. If anybody wants to put some bets in the chat, and actually, yeah, let's do this. What do you guys think? So, you guys in the chat, we got 15 people still on the call. Type in the chat. What do you think? Is it gonna be 75, more than 75, or less than 75? 0.75%. I'm saying 75 up. He's saying 0.5 or down, or around 0.5. So let us know what you think. And cool. I mean, we should be live in a minute. So once we go live, I think we can raise the volume a little bit, and for the Fed meeting, and turn our volume down. Not just listening. And if we got some comments, we'll put some comments in as we go live. That's the whole point. But I also want you guys to be able to hear what they have to say. The Q&A is usually the most hilarious part, so we can bullshit about that. We can have a bit of a fun. There we go. All right, let me raise the volume. All right, I got my button ready on buy or sell. See what they say. Very quiet.
Yeah, I'm interested to see the question that are going to come today, because the situation is not looking good. Like they're all talking about maximum unemployment. In the last report, like the open jobs role decreasing by like 50.
There's my man. There's my man. Look at him, so confident.
There you go.
All right.
Good afternoon. I will begin with one overarching message. We at the Fed understand the hardship that high inflation is causing. We're strongly committed to bringing inflation back down, and we're moving expeditiously to do so. We have both the tools we need and the resolve that it will take to restore price stability on behalf of American families and businesses. The economy and the country have been through a lot over the past 2.5 years and have proved resilient. It is essential that we bring inflation down if we are to have a sustained period of strong labor market conditions that benefit all. From the standpoint of our congressional mandate to promote maximum employment and price stability, the current picture is plain to see. The labor market is extremely tight, and inflation is much too high. Against this backdrop, today the Federal Open Market Committee raised its policy interest rate by 0.75 of a percentage point and anticipates that ongoing increases in that rate will be appropriate. In addition, we are continuing the process of significantly reducing the size of our balance sheet. I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. Overall economic activity edged down in the first quarter as unusually sharp swings in inventories and net exports more than offset continued strong underlying demand. Recent indicators suggest that real GDP growth has picked up this quarter, with consumption spending remaining strong. In contrast, growth in business fixed investment appears to be slowing, and activity in the housing sector looks to be softening, in part reflecting higher mortgage rates. The tightening in financial conditions that we've seen in recent months should continue to temper growth and help bring demand into better balance with supply. As shown in our summary of economic projections, FOMC participants have marked down their projections for economic activity, with the median projection for real GDP growth running below 2% through 2024. The labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies at historical highs, and wage growth elevated. Over the past 3 months, employment rose by an average of 408,000 jobs per month, down from the average pace seen earlier in the year, but still robust. Improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand is very strong, while labor supply remains subdued, with the labor force participation rate little changed since January. FOMC participants expect supply and demand conditions in the labor market to come into better balance, easing the upward pressures on wages and prices. The median projection in the SEP for the unemployment rate rises somewhat over the next few years, moving from 3.7% at the end of this year to 4.1% in 2024, levels that are noticeably above the March projections. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in April, total PCE prices rose 6.3%, excluding the volatile food and energy categories. Core prices rose 4.9%. In May, the 12-month change in the Consumer Price Index came in above expectations at 8.6%, and the change in the core CPI was 6%. Aggregate demand is strong. Supply constraints have been larger and long-lasting than anticipated, and price pressures have spread to a broad range of goods and services. The surge in prices of crude oil and other commodities that resulted from Russia's invasion of Ukraine is boosting prices for gasoline and food, and is creating additional upward pressure on inflation.
In an update for people who didn't catch that, the rate hike was 0.75%, so I did get one Cardano.
FOMC participants have revised up their projections for inflation this year, particularly for total PCE inflation.
And I think what's interesting as well is looking at the volumes here on the charts. It's very still. I was expecting a lot of movement, and volume-wise, it's very quiet. Very, very quiet. And Nasdaq is moving quite a lot as well. Sorry, not much as well. So you're going to have to wait.
As weighted to the upside. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. Against the backdrop of the rapidly evolving economic environment, our policy has been adapting, and it will continue to do so. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 of a percentage point, resulting in a 1.5 percentage point increase in the target range so far this year. The committee reiterated that it anticipates that ongoing increases in the target range will be appropriate. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Coming out of our last meeting in May, there was a broad sense on the committee that a half percentage point increase in the target range should be considered at this meeting if economic and financial conditions evolved in line with expectations. We also stated that we were highly attentive to inflation risks and that we would be nimble in responding to incoming data and the evolving outlook. Since then, inflation has again surprised to the upside. Some indicators of inflation expectations have risen, and projections for inflation this year have been revised up notably. In response to these developments, the committee decided that a larger increase in the target range was warranted at today's meeting. This continues our approach of expeditiously moving our policy rate up to more normal levels, and it will help ensure that longer-term inflation expectations remain well anchored at 2%. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 3.4% at the end of this year, a percentage point and a half higher than projected in March, and 0.9 percentage point above the median estimate of its longer run value. The median projection rises further to
I think just looking at the charts, we are pretty much trading as very clean, I would say. Like, we're being rejected at the moving averages. We're using moving averages as support. I think not seeing any unusual moves or any crazy moves. So maybe, maybe we got away. It wasn't bad. I think meeting expectations is always good to neutral. So maybe you were right. Maybe this was priced in cryptos as well.
We anticipate that ongoing rate increases will be appropriate. The pace of those changes will continue to depend on the incoming data and the evolving outlook for the economy.
Go again?
Clearly, today's 75 basis point
So he's looking like it right now.
large one, and I do not
Yeah,
expect
there we go.
this size to be common.
We
From
are.
the perspective of today, either a 50 basis point or a 75 basis point increase seems most likely at our next meeting. We will, however, make our decisions meeting by meeting, and will continue to communicate our thinking as clearly as we can. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves in unexpected ways. Inflation has obviously surprised to the upside over the past year, and further surprises could be in store. We therefore will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty to what is already an extraordinarily challenging and uncertain time. We are highly attentive to inflation risks and determined to take the measures necessary to restore price stability. The American economy is very strong and well positioned to handle tighter monetary policy. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
All right. Before we get to the questions, just want to point out we actually got a pretty healthy 2.5% out of the trade. So I'm pretty happy with that.
The language you used at the last press conference on 50 basis point hikes in June and July. And would you please give us as detailed a sense as you can of what role you played in reshaping market expectations so quickly on Monday?
So, as you know, we always aim to provide as much clarity as we can about our policy intentions, subject to the inherent uncertainty in the economic outlook, because we think monetary policy is more effective when market participants understand how policy will evolve, when they understand our objective function, our reaction function. And in the current highly unusual circumstances with inflation well above our goal, we think it's helpful to provide even more clarity than usual, again, subject to uncertainty in the outlook. So, and I think over the course of this year, financial markets have responded and have generally shown that they understand the path we're laying out. Of course, it remains data dependent, and so that's what we generally think about guidance, and that's why we offer it. And of course, when I offered that guidance at the last meeting, I did say that it was subject to the economy performing about in line with expectations. I also said that If the economy performed, if data came in worse than expected, then we would consider moving even more aggressively. So we got the CPI data and also some data on inflation expectations late last week, and we thought for a while, and we thought, well, this is the appropriate thing to do. So then the question is, what do you do? And do you wait 6 weeks to do it at the next meeting? And I think the answer is that's not where we are with this. So we decided we needed to go ahead, and so we did. And that's really how we made the decision.
Okay, Gina?
Thanks for taking our questions. Gina Smilik with the New York Times. I guess I wonder if you could describe for us a little bit how you're deciding how aggressive you need to be. So obviously 75 today. What did 75 achieve that 50 wouldn't have, and why not just go for a full percentage point at some point?
Sure. So if you take a step back, what we're looking for is compelling evidence that inflationary pressures are abating and that inflation is moving back down. And we'd like to see that in the form of a series of declining monthly inflation readings. That's what we're looking for. And by this point, we had actually been expecting to see clear signs of at least inflation flattening out and ideally beginning to decline. We've said that we'd be data dependent, focused on incoming data, highly attentive to inflation risks, the things that I mentioned to Howard moments ago. So contrary to expectations, inflation again surprised to the upside. Some indicators of inflation expectations have risen, and projections of this year have moved up notably. So we thought that strong action was warranted at this meeting, and today we delivered that in the form of a 75 basis point rate hike, as I mentioned. So what was the point of it really is this. We've been moving rates up expeditiously to more normal levels. And over the course of the 7 months since we pivoted and began moving in this direction, we've seen financial conditions tighten, and appropriately so. But the federal funds rate, even after this move, is at 1.6%. So again, the committee is moving rates up expeditiously to more normal levels, and we came to the view that we'd like to do a little more front-end loading on that. So I think that the SEP gives you the levels that people think are appropriate at given points in time. This was really about the speed with which you would get there. So as I mentioned, we 75 basis points today. I said the next meeting could well be about a decision between 50 and 75. That would put us at the end of the July meeting, in that range in that more normal range, and that's a desirable place to be because you begin to have more optionality there about the speed with which you would proceed going forward. Just talking about the SEP for a second, what it really says is that committee participants widely would like to see policy at a modestly restrictive level at the end of this year. And that's 6 months from now. And so much data and so much can happen. So remember how highly uncertain this is. But so that is generally a range of 3 to 3.5%. That's where people are. And that's what they want to see, knowing what they know now and understanding that we need to show resolve, but also be flexible to incoming data as we see it. If things are better, we don't need to do that much. And if they're not, then we either do that much or possibly even more. But in any case, it will be very data dependent. Then you're looking at next year, and what you're seeing is people see a bit more tightening and in a range of maybe 3.5% to 4%. And that's generally what people see as the appropriate path for getting inflation under control and starting back down and then getting back down to 2%. So 75 basis points seem like the right thing to do at this meeting, and that's what we did.
Steve Leisman, CNBC. Thank you for taking my question, Mr. Chairman. You have not used the phrase in a long time, monetary policy is in a good place, which is a phrase that you used to use often. Now that the committee is projecting 4% or 3.8% next year in terms of the funds rate, which is similar to where the market is now, the futures market of 4% funds rate next year. Do you think that's a level that is going to be sufficiently high enough to deal with and bring down the inflation problem? And just as a follow-up, could you break that apart for me? How much of that is restrictive, and how much of that is a normal positive rate that ought to be embedded or not, in your opinion, in the funds rate? Thank you.
Sure. So the question really is, how high does the rate really need to go? And this is, the estimates on the committee are in that range of 3.5% to 4%. And how do you think about that? Well, you can think about the longer run neutral rate. You can compare it to that, and we think that's in the mid-2s. You can look, frankly, at broader financial conditions. You can look at, asset prices. You can look at the effect you're having on the economy, rates.
Right, what do you think?
Prices, credit spreads, all of those things go into that. You can also look at the yield
Yeah,
curve
I mean,
and ask all along the yield curve where
we said that probably the
policy
most
rate. So
for
us, the
selling
yield curve
capitulation
now,
already happened,
real
and
rates are positive.
probably the market
That's
was
not
just
true.
waiting for a bounce
At
up,
the short end of the yield curve in the early years,
especially because it's correlated to macro,
where
and macro already priced in 75 bips.
that really is one data
Yeah.
point. It's one part of.
Yeah, I think I would agree. I think looking at the volume, looking at what's happening, definitely is the correlation right now, cryptos to stocks is just, it's right there. It's right there. So 1-to-1, Bitcoin to Nasdaq reacting pretty well. And actually, I kind of regret selling quickly because talking about technical trading or trading as a whole, this is where the announcement happened. So $20,600. And I sold out at the first resistance level just about here, so 3.5%, because technically speaking, I was thinking that since we met expectations, I wasn't really hoping for an incredible amount of volume. I was hoping for relief bounce. Actually went all the way up to 8.8%. Of course, can't predict that, but still, kind of regret selling slightly too early in this trade. But good. We got that 3% out of the announcement, so not too bad. And yeah, well, let's see. See what else they ask. I think some of the questions were kind of boring, to be honest.
I think it's certainly in the range of plausible numbers. I think we'll know when we get there, really. I mean, honestly, that would be, you would have positive real rates, I think, and inflation coming down by then. I think you'd have positive real rates across the curve. I think that the neutral rate is pretty low these days. So I would think it would, but
good to see a meeting in person.
We're going to find that out empirically. We're not going to be completely model-driven about this. We're going to be looking.
It's good to see a meeting that is in person, because all the other meetings.
Oh, yeah, you're right. All the previous ones were still COVID related, still online. Yeah. There you go. Next question. I want to see one of the sassy questions. Waiting for the very
Thanks. Nick Timmeros of the Wall Street Journal. Chair Pell, you've said that you like your policy to work through expectations, and now obviously this decision was something quite different from how you and almost all of your colleagues had set those expectations during the intermeeting period. And I know you just said that what changed was really the inflation data, the inflation expectations data, but I'm wondering on the inflation expectations data, was there something you saw that was unsettling enough to risk eroding the credibility of your verbal guidance by doing something so different from what you had socialized before?
So if you look at we look at a broad range of inflation expectations. So you've got the public, you've got surveys of the public and of experts, and you've also got market-based. And I think if you look across that broad range of data, what you see is that expectations are still in the place, very much in the place, where short-term inflation is going to be high, but comes down sharply over the next couple of years. That's really where inflation expectations are. And also, as you get away from this episode, they get back down close to 2%. And so this is really very important to us that remain the case. And I think if you look for most measures, most of the time, that's what you see. If we even see a couple of indicators that bring that into question, we take that very seriously. We do not take this for granted. We take it very seriously. So the preliminary Michigan reading, it's a preliminary reading. It might be revised nonetheless. It was quite eye-catching, and we noticed that. We also noticed that the index of common inflation expectations at the board has moved up after being pretty flat for a long time. So we're watching that, and we're thinking, this is something we need to take seriously. And that is one of the factors, as I mentioned, one of the factors in our deciding to move ahead with 75 basis points today was what we saw in inflation expectations. We're absolutely determined to keep them anchored at 2%. That was one of the reasons. The other was just the CPI reading.
So if you saw a movement...
I don't really see it going down to 2%, to be honest, by the end of the year. What were you saying about? You were saying 3.5?
basis point increase in play.
Yeah, I think it's going to be very hard to get it down to 2% again. Probably like 3.5 is a good target.
Appropriately, I think. So
I don't see it 2% by the end of the year, maybe in the next couple of years. By the way, just looking at some altcoins, Phantom is up 16% since the announcements. Cardano is actually up 16%. So thank you very much for an extra 16%. And Theta is up 14%. So I think altcoins and smaller caps are definitely following. Ethereum, it's kind of on the same line. I think we got another 8% here. No, actually 14% as well.
Hi, Chair Powell. Neil Irwin from Axios. Thanks for taking our questions. The late-breaking kind of decision to go to 75 basis points, do you worry that that will make policy guidance a less effective tool in the future? And should we think of that as a kind of symmetrical reaction function if we start to get soft readings on inflation or if the labor market starts to roll over?
To take your second question first, yes. I mean, I think we're resolved to take this on, but we're going to be flexible in the implementation of it. Sorry, and your question was guidance. So again, the overall exercise is that we try to provide as much clarity about our policy intentions as we can, because we think that makes monetary policy work better. It's always a trade-off, because you have to live with that guidance. And so you do it, and it helps a lot of the time. I frankly think this year has been a demonstration of how well it can work. With us having really just done a very little in the way of raising interest rates, financial conditions have tightened quite significantly through the expectations channel, as we've made it clear what our plans are. So I think that's been a very healthy thing to be happening. So, and I would hope that it's always going to be, any guidance that we give is always going to be subject to things working out about as we expect. And in this particular situation, we're looking for something specific, and that is progress on inflation. We want to see progress. We want to see, inflation can't go down until it flattens out. And that's what we're looking to see. And if we don't see that, then that's the kind of thing that will cause, even if we don't see progress for a longer period, that could cause us to react. But we will, soon enough, we will be seeing some progress at some point. And we'll react appropriately to that too. But
Somebody in chat was saying Algorand actually pumped over 30%, so we're just checking that out. I mean, true, but 31%. I kind of feel like that's unrelated, because that candle printed, so those quotes are from 1929 British time, and the announcement was actually made in 1932, and the meeting only started in 1930. So I don't think this bump on Algorand it's related to the announcement. And if we normalize it, we got 10% out of the announcement, which is more realistic.
Thank you so much for taking our questions. Colby Smith with the Financial Times. On the clear and convincing threshold for the inflation trajectory, what is the level of realized inflation that meets that criteria? And how is the committee thinking about the potential trade-off of much higher unemployment than even what's forecasted in the SEP if inflation is not moderating, at this acceptable pace?
Sorry, the second part I didn't get.
What's the potential trade-off with higher unemployment than even what's forecasted in the SEP if inflation is not moderating at an acceptable pace?
Right. So what we want to see is a series of declining monthly readings for inflation, and we like to see inflation headed down. So, but and right now our policy rate is well below neutral, right? So, soon enough we'll have our policy rate. Let's assume the world works out about like the SEP says. The policy rate will be up where we think it should be, and then the question would be, do you slow down? Does it make you, that you'll be making these judgments about, is it appropriate now to slow down from 50 to 25, let's say, or speed up? So that's the kind of thinking we'll be doing, and we're looking, ultimately, we're not going to declare victory until we see a series of these, really see convincing evidence, compelling evidence that inflation is coming down. And that's what I mean by, that's what it would take for us to say, okay, we think this job is done.
They already
because we saw, and frankly, we saw last year.
Sorry, gone.
Inflation came down over the course of
they are already laying the ground to pivoting. So they're already talking right now to when they're going to pivot.
Pivot in what sense? On the dollar?
They're tightening.
Are you more
Tightening to easing?
I mean, they're going to keep tightening. I mean, pivoting would be the opposite of tightening, right? It would be relaxing.
Yeah, but they're already saying that the condition they're going to require. So when they're going to see more readings going down, they're going to probably like decelerate.
Their objective, and this is what's reflected in the S&P.
They're not going to look at Bitcoin, though.
Yeah, definitely not. But I mean, it's kind of positive they're already talking about the fact that they're gonna decelerate the tightening.
Well, the thing is,
now.
if they don't hit the 2% target by the end of the year, I don't see them doing anything like that until next year anyway. So I mean, we're in for another 1 point. We'd raised by 1.5% since they started. We got another 6 months to go until the end of the year. That's under 1.5, if not 2% rate hikes. If they got this rate as well, this was 7.5, right? If they know the 4 meetings like this, it's 3%. Total for 5% hike over the year. So you know we could go way down from here, and I was expecting to see positive results already. They were expecting to see decrease. Like the last meeting seemed really positive, and now we got 8.6%. And then the whole thing about the CPI not being that realistic as well. Like they could do the same thing again. They could just publish a CPI and say, oh, inflation's down. We're gonna slow down the rate hikes, but is it really down?
Led to a real imbalance in wage negotiating. You could get to a place where that ratio was at a more normal level, and you would expect to see those wage pressures move back down to a level where people are still getting healthy wage increases, real wage increases, but at a level that's consistent with 2% inflation. So that's a possibility, and you could say the same thing about some of the product markets where there's just excess capacity. And you know where the strong demand has gone into where they're capacity constrained, right? So you have effectively what we think of as a vertical supply curve or close to it. So demand comes in and it's very strong, and it shows up in higher prices, not higher quantities, not more cars, because they can't make the cars because they don't have the semiconductors. So in principle, that could work in reverse. When demand comes down, you could see, and it's not guaranteed, but you could see prices coming down more than the typical economic relationships that you see in the textbooks would suggest because of the unusual situation we're in on the supply side. So there's a pathway there. It is not going to be easy, and you know again, it's our objective, but as I mentioned, it's going to depend to some extent on factors we don't control.
Rachel.
Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from The Washington Post. So the new projections show the unemployment rate ticking up through 2024. Is a higher unemployment rate necessary in order to combat inflation? And what is lost if the unemployment rate has to go up and people lose their jobs in order to control inflation? Thank you.
That's the question I wanted.
So you're right. In the SEP, we have unemployment going up to the median is 4.1%. There are, of course, a range of actual forecasts, and I would characterize that if you were to get inflation down to, you know, on its way down to 2%, and the unemployment rate went up to 4.1%, that's still a historically low level. You know, we hadn't seen unemployment rates below 4% until a couple of years ago. We'd seen it for like 1 year in the last 50. So the idea that 3.6% is historically low in the last century. So a 4.1% unemployment rate with inflation well on its way to 2%, I think that would be I think that would be a successful outcome. So we're not looking to have a higher unemployment rate, but I would say that I would certainly look at that as a successful
it's definitely not looking good. Like the curve, you can see that it's turning around. There's low for that employment is. And the last report showed like 1,500,000 less job opening, and you can see the pace of the curve. I think on them, if you go on the Fed website, so it's a Fred, I think, unemployment. There's a chart.
That one.
go back and establish price
Yeah,
stability.
you can see that it's turning down.
Kind of labor market, and that's a labor market
But
where,
just put the last months.
where workers are getting wage increases. Maybe the workers at the lower end of the spectrum are getting the biggest wage increases, as they were before the pandemic. Where participation is high.
I mean, it's not wrong. Like, pandemic-wise, we go up to 14% unemployment, and we're now down to 3.6. And historically, if you look at the last 20 years, it is definitely a bottom. If you look at 2008, 2008.
Yeah, I would look at the slope of the curve.
What's your point?
Rather than just the number. I will look at the slope of the curve. So when, as you can see, every time the slope changes, there is a very big uptick, because it's every time is always caused by stimulated growth, and then as soon as the short-term effect of the newly created money finished, it just jumps up so much. You can say right now we are at a pivoting point. Just zoom in the last month instead of the last year.
Well, that's
We're definitely turning around here.
Yeah, but I would see this as a positive, the same way J. Powell put it. Like, I don't see this as a negative pivoting point. Okay, we are.
yeah,
okay, I see
now.
what you're saying. We are at the lowest point now. We could pivot from here upside. So that's what you're saying. Like, if we're trying to bring inflation down, but unemployment-wise, historically speaking, from here there is only a way up, really.
Consistent with a strong labor market. That's what we're trying to do.
Yeah. I think that's probably one of the other factors, rather than just the market tanking like 50%. The other one is unemployment ticking up.
That's kind of what the SEP says. That the SEP has inflation getting down to a little above 2% in 2024, with unemployment at 4.1%. So, and this is a strong labor market. This is a good labor market. And as I mentioned, there are pathways to do it. But those pathways have become much more challenging due to factors that are not under our control. Again, thinking here of the fallout from the war in Ukraine, which has brought a spike in prices of energy, food, fertilizer, industrial chemicals, and also just the supply chains more broadly, which have been larger and longer lasting than anticipated. So the sentence that we deleted said that we believe that appropriate monetary policy effectively alone can bring about the result of 2% inflation with a strong labor market. And so much of it is really not down to monetary policy. It just didn't, the sentence isn't, it kind of says on its face that monetary policy alone can do this. And that just didn't seem appropriate, so we took the sentence out.
And given the new projections for the unemployment rate, could you talk a little bit about what accounts for such reduced confidence against, say, a month ago or 3 months ago, that inflation will largely normalize on its own as these supply side issues get worked out? Thanks.
Well, yeah, I think you've seen, again, we've been expecting progress, and we didn't get that. We got sort of the opposite. So I also think the situation, really since the consequences of the Ukraine war become more and more clear, what you're seeing is the situation getting more difficult. And you look around the world, I mean, lots of countries are looking at inflation of 10%, and it's largely due to commodities prices. But all over the world, you're seeing these effects, and so and we're seeing them here. Gas prices, all-time highs and things like that. That's not something we can do something about. So that is really. And by the way, headline inflation is important for expectations. The public's expectations. Why would they be distinguishing between core inflation and headline inflation? Core inflation is something we think about because it is a better predictor of future inflation. Oh. But headline inflation is what people experience. They don't know what core is. Why would they? They have no reason to. So expectations are very much at risk due to high headline inflation. So it's become, the environment has become more difficult, clearly, in the last 4 or 5 months.
Yeah, the UK is not having the best time here.
And hence the need for the policy actions that we took today, hence our resolution to get rates up and ultimately get them to where we think they need to be in coming months.
Thanks, Chair Powell. Edward Lawrence with Fox Business. I want to ask you, you talked about CPI.
Oh, well, one more, and then I think we can close the stream. I'm going to have to go.
By falling, and then revisions to the previous months were down. Are you hearing from contacts about consumers slowing spending or changing their habits?
So we're of course watching very, very carefully for that, and looking at the retail sale, the big store numbers and all that kind of thing. And so, but I think the fair summary of what we see is you see continuing shifts in consumption. You see some things sales going down, but overall, spending is very strong. The consumer's in really good shape financially. They're spending. There's no sign of a broader slowdown that I can see in the economy. People are talking about it a lot. Consumer confidence is very low. That's probably related to gas prices. And also just stock prices to some extent for other people.
Even more than
that. But that's what we're seeing. We're not seeing a broad slowdown. We see job growth slowing, but
still didn't reflect too much in the normal life, which is good.
We see the economy slowing a bit, but still growth levels, healthy growth levels.
So then as you are raising rates in this economy, how closely are you watching consumer spending, or is there another indicator that you're watching more closely?
It would be hard to watch anything much more closely than we watch consumer spending, but we watch everything. We watch business fixed investment, which actually has softened a bit. We're responsible for watching everything, but consumption is 60-some% of the economy, 2/3 of the economy. So naturally, we spend a lot of time on that. And again, there's a lot going on. There are a lot of flows back and forth, but ultimately, it does appear that the U.S. economy is in a strong position and well positioned to deal with higher interest rates.
Right, I think we can stop it there. I don't know how much you agree with the last statement of the U.S. economy being in a strong position to deal with the interest rates. Although, I mean, it is true that in the last 6 years, especially in the technology space, with being, if you look at the Nasdaq just in the last 4 or 5 years, since 2014 up to today, I mean, it's been up only, right? So he's not lying when he says they're probably in a pretty strong position as of today. I mean, okay, well, we don't get much data.
Hey, stocks is not the economy. Stocks is just.
Well, I mean, if you look at it, if you're looking at an index,
if you adjust it for M2 for inflation, for the money supply growth, it's actually flat.
Okay.
I mean, GDP, it kept rising for like 1.5, and the only negative print that we had was last quarter. But then right now, even one of the very good metrics that I discovered lately is called PMI. So I think it's Producer Manufacturing Index. And it's basically I think it's one of the best because it's very forward-looking, because our Purchasing Manager Index. Because basically, I think, probably it's better to read the definition rather than me just saying random things.
Let's do a knowledge share moment. So there we go. So Purchasing Manager Index. PMI is an index of prevailing direction of economic trends in the manufacturing and service sectors. Yeah, the whole discussion is around manufacturing and supply chains as well. It consists of a diffusion index that summarizes whether market conditions as viewed by purchasing managers are expanding, staying the same, or contracting. Yeah, so basically expansion of market conditions or contraction of market conditions. Let me see if I can find it.
Yeah, I think the chart works pretty much. If it's under 50, the economy is contracting. If it's over 50, it's expanding. And right now, we're just turning around almost under 50.
That's it. I think that's
53, but yeah, you can see, if you can see the graph, it's definitely trending down. So yeah, the economy looks like this is very forward indication. Yeah.
All right, that's COVID.
Yeah, it looks like right now
right there. That's to test 2008. So let's put Instagram in. Oh, well, I guess it gives you, okay.
I mean, I agree that the economy is very strong, but then looking at the Nasdaq, I can see with 2x, like we did 100% return in 1 year, it doesn't really reflect. We still had like a very constant growth on the economy, but not as much as it was reflected by the stocks, especially because of the monetary policy and inflation that we just had. So assets just overinflated.
All right.
Everyone feels richer, but it's actually not.
Well, after the last couple of months, I'm not sure that's a true statement anymore. Right? Should we close it here? I think that's it, guys. Thanks for joining us. I think good call. We got what I expected. You owe me one other. and pull out a nice little trade here. So definitely don't forget to come and join our Discord, follow us on Discord. Join our Twitter as well, follow us on Twitter. We post a lot of the trades and NFTs that we follow on there. We're going to try to do as many calls as we can and stick out with our community. We're doing a lot of projects at the moment, so we're quite busy. But come September forward, we're going to try to get more and more involved with the community. Anything you want to add before we close?
No, that's pretty much it. I think, yeah, like one of the aims is to build our DAO and really show all the amazing feature of our dashboard and app. And yeah, in the future, we actually, then the main product is going to be our like group investing. So we're probably going to start building our community, especially using the interaction on Discord, and then actually building the infrastructure with NFTs and smart contract. And hopefully in the future, actually build a nice protocol with revenue system. So yeah, stay tuned for all the development.
Cool. Thanks everyone. Thank you. Have a nice evening. Cheers. Thanks. Bye.
Cheers.